Well, as we just talked about, the September PCE report came in line with expectations, showing inflation rose 2.8% from a year earlier. That is, by the way, the fastest pace that we had seen since spring of 2024. It's also the last major piece of economic data to be released before the Federal Reserve's December meeting. Investors still expect the Fed to cut rates on December 10th. My next guest says the U.S. economy could be heading for a code red affordability moment. I want to bring in Ed Yardeni Research President. Ed, it's great to see you. I love that blue there today, Ed.
Thank you.
So let's talk about the PCE that we just got. Obviously, it is dated, but I'm curious more broadly how you're thinking about the pace of inflation right now, reading the tea leaves between September and now.
Well, I think the data clearly suggests that we probably would have been down to 2% on a year-over-year basis by now, but for the tariffs. The tariffs did have an impact on inflation in durable goods. Durable goods inflation was actually falling on a year-over-year basis at the beginning of the year, and then it started increasing a bit, reflecting the tariffs. But that's probably a one-shot deal, and I think that looking into next year, inflation will come down from close to 3% to closer to 2%. So that's looking promising.
So that implies that you do think the Fed has ample room to cut then next week and beyond?
I think that's going to be their perception. I don't think they really need to. I think the economy is doing fine without rate cuts, and rate cuts increase the possibility of financial instability, particularly a melt up in the stock market, which are fun on the way up, but you have to remember to get out at the top. But look, the inflation news, I think, is going to increase the odds that the Fed will go ahead and do a quarter point. But it may be a hawkish cut. We may have more dissenters saying, what's the rush? We have more dissenters saying that maybe they should wait until next year for another rate cut.
And Ed, if you do get that hawkish dissent, obviously the market broadly expects the cut to happen. But if you get that hawkish dissent, if you get some of that, what then do stocks do?
Well, I think we could have a day or two where there's downward pressure to the extent that the markets are expecting that there will be another rate cut after December 10th, that there might be another rate cut maybe even as early as January at the next meeting. So I don't think it's going to be anything particularly earth-shattering one way or the other. I think the market's going to kind of continue to deal with some of the issues we have now with the horse race going on in the entire AI world and trying to figure out who the winner is today. So I think that kind of complicates that trade. And meanwhile, I think the market is going to increasingly focus on the likelihood that next year is going to be a good year for the economy again. We've got a lot of stimulus coming into the economy between some tax cuts, between the World Soccer, and then there's the 250th birthday of the United States. So there's going to be a lot of spending going on next year, and the market may be starting to anticipate that. It could be another really good year. I mean, I think we could have another double-digit increase in the S&P next year of maybe 10%. I think we'll end the year around 7,000.
And this year around 7,000?
This year, 7,700 by the end of next year.
And Ed, what about the affordability question, right? I mean, it sounds like you're a little bit more optimistic on inflation coming down.
Yeah.
And if that stimulus is coming in, does that become less of a discussion next year?
Not necessarily. The affordability issue is a little bit complex. It's also a little bit psychological. We have clearly had a huge increase in prices since the beginning of the pandemic, over 20%. The thing is, average hourly earnings, which is a measure of wages, has actually increased a bit more than that. The problem is it's comparing apples to oranges. The reality is average hourly earnings is exactly that. It's an average, and there's plenty of people below the average that haven't kept up with those big price increases. And then on top of all that, you've got young people coming out of colleges or people 20 to 24, their unemployment rate has really almost doubled since last year. And so the code red is really the code red for the administration. They clearly have become very concerned that if the affordability issue is one that could sink their majority in the House.
How much room do they have to address it?
Not much, really. In terms of what they could possibly do. I mean, let's face it, energy prices have come down significantly, and that was always kind of viewed as a key view of what overall inflation's been doing. And yet people just still aren't happy with what they're seeing.
Well, I mean,
And
energy in the form of gasoline has come down, but in the form of electricity, that's
correct.
another story.
That's another story. And of course, the insurance policies for autos, for homes, life insurance have all gone up dramatically. So this is a problem, and I'm not sure that it can be solved by the administration in time for them to maintain their lead in the House in the midterm next year.
So, Ed, do you think that affordability is an issue from an economics perspective as well, or do you think it is primarily a political problem?
I think it's primarily a political problem because we have seen that the affordability crisis probably has shown up in quite depressed consumer confidence surveys, and that in turn is related to the affordability issue. So I think it's more a political problem because the reality is the consumer numbers have been pretty strong. The numbers you just reported this morning, they were okay. They weren't great. Up to 0.3 for consumption isn't really an increase when you adjusted for inflation. But 1 month doesn't make the trend. The trend is certainly for consumers to continue to spend, which is what they've been doing.
You mentioned what's going on with AI, and I want to just circle back to that because you talked
Sure.
about the horse race that's going on with AI. Given that we sort of, instead of everything going up, we now have a little bit more, at least in the market recently, a little more dispersion among those AI names. Do you think that's
Right.
broadly going to be supportive for stocks going higher? Or do you think, as you said, it's more complicated now?
Yeah. Well, it's more complicated, but I see a happy outcome. For quite some times, the Magnificent Seven have been really the concentrated focus of the bull market. I mean, if they didn't exist, we'd still have a bull market. It just wouldn't be as impressive as what we've had with the Magnificent Seven. And for a while, they've been driven by the notion that they're all the winners in AI. Now it's recognized that it's become a lot more competitive, and it's maybe what this really means is that the investors will start to focus on the what I call the impressive 493. The other stocks in the S&P 500 that are likely to show that these technologies, including AI, are being used to increase productivity, which in turn is very good for corporate profits. So a broadening in the market to the 493 makes a lot of sense to me.
And Ed, I know you and your team watch Bitcoin as well, and Bitcoin has had such an interesting relationship with stocks recently also.
Yeah.
So what's your outlook there, and not just for the price of Bitcoin itself, but also for the interplay?
Well, it's basically proven itself to be a trading vehicle, a risk-on, risk-off kind of instrument. It had a sell-off a couple of years ago and then Wall Street came to its rescue and decided that they wanted to create ETFs in that area. Vanguard just kind of folded. They were saying that they weren't going to do anything with Bitcoin. Now they are going to do ETFs. And of course, we've got a very pro-crypto administration. So, it hasn't really been about fundamentals. It's been a kind of a lot of technical issues here. And then the Genius Act, which was passed in July, basically took away the transactions function of Bitcoin because now we're going to have stablecoin. And stablecoin is a cryptocurrency. It is blockchain based, and it can be used for transactions very safely, I believe. And so that leaves Bitcoin basically as a store of value, and it's been one heck of a roller coaster if you're looking for a store of value that keeps going up and up, which is what gold has been doing rather than Bitcoin. So ironically, Bitcoin's been said to be a digital gold, and gold maybe is physical Bitcoin, and gold seems to be doing better than Bitcoin.
It does, ironically enough. Ed, thanks so much. It's good to see you.
Thank you.
We're all trying to figure out what's going to happen next year here. You guys think that there will be 2, maybe 3 more cuts. You talk about 3% as like the floor for where they're going. Why is that?
We just don't think there's too much of a need right now to cut more aggressively. And we don't think they even need to cut much further from here. When we say 2 or 3, that's including the likely cut next week, which means probably 2 more sometime in 2026. But right now, obviously all our eyes are on the labor market, but inflation is still too high. I think that's really something that we know that there's a lot of Fed officials who are a little bit nervous about that. And as this year ends, we get a new rotation of voters in there. A lot of the incoming voters have voiced their concerns about sticky inflation. So we think that should slow down the pace of rate cuts a little bit. And absent a recession, I mean, that's the really big key right now. Absent a significant slowdown where the Fed needs to cut to stimulate, we think 3% should be that floor.
It feels like the wild card here might be Kevin Hassett. If he indeed is picked as the next chair of the Federal Reserve, and it looks like he probably will be, what is the risk that he's going to cut as far as the eye can see, because that's what the president wants him to do?
Very low risk, I should say.
Why is that low risk?
He's just 1 vote. So this is the way we're looking at it right now, and there's so many moving parts with Stephen Miran. He's done after this month.
Right.
Lisa Cook is still there, and Fed Chair Powell is still a governor for now, and he's been very tight-lipped about what his plans are going to be. It's really interesting. So this is just one new governor who may or may not be the Fed chair come middle of next year. It's just 1 vote, and the math doesn't change much, knowing that he will be replacing just another Uber Dove. If the administration or the Supreme Court rules that Lisa Cook could be fired, and if Fed Chair Powell does actually retire when his chair term ends, then I'd say all bets are off, because we'll probably see more dovish members in there. But just with Kevin Hassett, I don't think it changes too much. Unfortunately, as someone who really values the Fed independence, it's kind of made a lot of officials kind of, I wouldn't say be political, but be more outspoken about what their views are. And I think he's going to have a hard time building consensus. That's really what the Fed chair does well. I think Powell's done a really good job there. But at the end of the day, he's just 1 vote.
Right.
So next year, I think we'll see a lot of dissents, probably, maybe in multiple directions. Unanimous decisions or 1 or 2 dissents are probably not what we're going to see. But just having Hassett in doesn't change the math for us right now.
Okay, but we'll see if that changes. So definitely watch this space, I think. The other thing that I think is really interesting is that even if the Fed cuts, it doesn't automatically mean that rates are all going to go down, and especially across the yield curve, right, on the longer end. And I know something that you're watching, and I also noticed it, by the way, this morning in Apollo's Torsten Slok, his top risks for next year. One of them is supply of treasuries and bonds out there. So talk me through how you're thinking about that too.
That's great. He's great. He must be reading our outlook. I'm flattered that we share the same view. But that's a big concern. We have 2 key concerns that we're not really worried that long-term yields are going to surge higher from here, but that they can stay around the 4% area with upside to maybe 4.5%. One is inflation. It's just too sticky, too high. And we think investors, knowing that we have this supply issues, might just demand higher yields even as the Fed cuts. Because let's say the Fed cuts to that 3% area, in a 3% inflationary environment, we're getting very close to negative real rates. So we think inflation, but those supply issues. Deficits aren't going away anytime soon. We've already seen our debt continue to rise this year. There doesn't appear to be an end in sight, but it's not just with treasuries. We're seeing a lot of corporate bond issuance, specifically with investment grade issuers, with the AI build out. We're even seeing a lot of municipal bond issuance, which is not something we've seen for years. They've kind of held steady. 2025 was a big year. We're expecting another big year next year. So we have a lot of issuance, and you need to find buyers for that debt. So again, not concerned. I don't want to be too concerned or scare anyone that we're going to see a 5, 6, 7% 10-year treasury. But we think that should limit the downside with potential, bumps up maybe to 4.5% or so.
Well, and that also means that all these people who are waiting for mortgage rates to go down to come into the housing market, maybe they're not going to come down that much.
Yeah, I hate to be the bearer of bad news. I mean, maybe a little bit. Now, one thing, it's not just the direction of treasury yields, 10-year treasury yields matters, but also spread. Now, the spread is still a little bit high, so maybe we can see them come down a little bit, even if the 10-year treasury yield kind of holds around 4%. But with our outlook for it to kind of hold steady here, we're not expecting to see mortgage rates, significantly fall lower.
Gotcha. Okay, so let's talk about strategy for fixed income investors for next year. And I thought it was really interesting what happened this year in terms of what did well. Emerging market debt did the best. What happens next year? Where should people be looking?
It's a very bond boring outlook, but we like high quality and intermediate term maturities. So we always want to look at what's our interest rate view, what's our credit risk view. So on interest rate risk, intermediate term maturities, we think that's just a nice balance. If you're focusing too much on short term investments, you have reinvestment risk. Even though we only expect 2 or 3 rate cuts, that still is lower yields, lower income as those rate cuts materialize. On the long end, maybe we're wrong and yields do rise a little bit higher if our outlook doesn't come to fruition. And that's always a bad outcome. A lot of individual investors don't fully grasp the volatility of long-term bonds. Treasuries are considered safe, but if you have a long-term bond, you can see large price swings. So we like kind of the belly of the curve as a nice balance there. And for credit quality, a lot of that comes down to just valuations. What are we being paid as investors to take a little bit more risk? And you're just not being paid too well in the riskier parts of the market. So, high quality investment grade investments like corporates, municipal bonds, mortgage-backed securities could be an opportunity, but we're not suggesting investors take too much risk.
Colin, I'm really curious. We have seen an explosion in recent years in bond ETFs, fixed income ETFs of all different kinds, but especially actively managed fixed income ETFs. Traditionally, the fixed income market has not been a place where retail investors have actively played that much, right? Is that changing with those ETFs, or is it still mostly institutionals, investors who are investing in those?
No, we're seeing individual investors go to ETFs, and there's pros and cons to every approach to bond investing. I think a benefit of ETFs is that it opens it up for investors who might not have the largest dollar amount to invest. That's always been something that prohibits investors. $1,000 par values, but a lot of times you want to buy more than that for liquidity purposes. So it's really hard to build a diversified portfolio at a low cost. And ETFs can offer that.
Right.
A tricky thing with ETFs, though, is that there's for most ETFs, no defined maturity date. So you kind of lose that predictable value at maturity. But they can be a good way to get a nice diversified portfolio with a steady income stream.
Gotcha.
OpenAI, Sam Altman issuing a code red alert to his employees. Do we need to send a code red alert on the economy? I mean, the job slowdown continues as seen through the prism of that ADP report this morning.
I don't put a lot of credit into the ADP report because it can be very volatile, right? People really look at the NFP report. I know we don't have one. We haven't had one. But I'm not. Today's report, the ADP report, doesn't necessarily cause me angst. Look, it might be causing the market angst because that's the story that they've told. That's the narrative they want people to understand, is that the labor market is softening. Oh, look, we have this data point that confirms the labor market softening. Look, unemployment is at 4.4%. That's historically low levels. That's essentially full employment. So I don't yet see that argument. I don't see that the labor market is falling off the edge. Nor do I see that the average consumer necessarily is concerned. They just spent $44 billion in 5 days between Black Friday and Cyber Monday. So there's a disconnect for me between what the consumer is doing and what the data is telling us. So I'm not in the camp that I'm worried about the job market falling off the edge. I think that the ADP number, while I understand it's a negative number, I'm not necessarily sure that really tells the whole story, right? I'm waiting for more of the government data from the NFP, which we're going to get in a couple of weeks. It's going to be delayed. I get it. But I think they've set it up for that narrative. So anything that confirms that narrative is what the market's going to run with.
Well, Kenny, I hear you saying, I personally, I just don't like this report. However, we're going to get a Fed decision in about 7 days, December 10th, that's coming.
Right.
Should a report like this seal the deal on a rate cut?
Well, listen, I think the deal's already sealed on rate cuts. I think and it's not going to make, the market's already pricing in the rate cut. So yes, I think it does, but I think that's not what investors should be paying attention to. They need to listen to what Jay Powell says about the guidance. Where are we going in January, February, March? Are we going to get these ongoing rate cuts? What do the macro data points tell the Fed, the FOMC committee, about where we're going in the future? Because the cut, tomorrow, next week's cut is already priced into the market. It's already there. We know it's there. 100% the market's betting it's there. It's going to be there. The question is going to be, what does he say about the future? And that's what's going to drive the next market move. If he tends to be a little bit more more hawkish or a little bit more controlled, and he sends the market this idea that maybe rates are going to stay where they will be now for a while, then we'll see how the market reprices. So yes, to the other guest point, we might see Bitcoin come under pressure. We might see the market come under pressure because everyone just wants more and more and more rate cuts. I'm in the camp that we shouldn't cut rates anyway. So this is against me, but I don't have a vote, right? I'm not on the committee.
You should get a vote, Kenny. You should get a vote. You should be on this committee.
I'm just not in the camp that the economy is going off the edge.
James, over to you. We get that rate cut next week. Is that what the crypto universe is waiting for? Is that their buy signal?
I think they're looking. Yeah, it definitely is. They're looking. The crypto market, along with other investors, are looking at lots of things. So indeed, job postings, job openings. ADP, I agree, statistically not great, but people are just looking for any kind of scraps of information as to where the market's, where the employment market's going. And I think it actually is not looking great. And what's going to really confuse things when we eventually get payrolls after the Fed decision is the shutdown and the confusion that causes, because that will muddy the waters in terms of the true employment picture, which I think is increasingly deteriorating. And that suggests that we'll get further rate cuts in January and March. And I think that onwards of dovish Fed will support Bitcoin prices.
Al, you know where we saw this K-shaped economy you talked about at the top of the show? Macy's earnings this morning. Bloomingdale sales up 8.8%. Good for them. High income shopper. Macy's sales up, 2.5%. Not so great for that mid-tier shopper.
Yeah, and really the retailers across the board have been giving us these warning signs over the past few quarters that the lower income consumer is under pressure. In that ADP report, small businesses were cited as centered at some of the biggest job losses. So that really paints this picture of how long this can be sustained. And it's actually something that I asked Bank of America during their 2026 outlook yesterday, because we do have this K-shaped stock market as well, where big tech continues to lead the way higher, whereas the other 493 stocks are trying to catch up. We have seen that broadening out, but still very much K-shaped in the stock market. And then you have a K-shaped economy. And they told me that at some point things are going to break. However, the one silver lining is that America is a services-oriented economy. That's where most of the jobs are. That's where most of the spending is. And the higher income consumer actually spends more on services than the lower income consumer. So that is why we have a lot of optimistic forecasts for GDP growth, for economic growth. Of course, AI productivity gains helping on that front as well. But even though there is some concern about the K-shaped economy, it is also something that I think has a little bit more room to run heading into 2026. But of course, we're watching everything that the retailers are telling us very closely.
Kenny, I'm just in a mood this week. Maybe I'm working out too much. I'm a little dehydrated. I put this poll out on my X account this morning. Will Macy's be around in 25 years? And it's a little bit more mixed than I thought, Kenny. I'll go over to you. Is Macy's here in 25 years?
You know, I'm not a Macy's shopper, so my guess is it will be, but it may be a very different looking Macy's than what it is today. But I don't go to Macy's, just to be clear.
Oh, you don't like Macy's? Well, if you go in there, there's nobody helps you. Nobody helps you.
That's right.
You got to find somebody. We need customer service.
Bloomberg reports that Kevin Hassett has emerged as the frontrunner to be the next Fed chair to replace Jay Powell. Joining me now is Stephanie Roth, Wolfe Research chief economist. Stephanie, it's good to see you. You, like all of us, you're thinking about 2026. You're trying to figure out what the picture is going to look like here. And you guys are looking for kind of trend growth, if I'm not mistaken, in terms of GDP for 2026. So how do you think that's going to play out?
Yeah, so I mean, it should be a decent year. This year it's been slightly below trend. We should see a bit of a pickup, specifically heading into tax season, which is where you'll see some consumer benefits, which should help specifically the sort of mid to lower end consumer. So there should be a benefit there. Now, it's not going to be a very robust year, but it should be fairly decent, which is one where the Fed's likely to cut in December, and then they're probably going to be on hold for a little while because growth will be picking up. Inflation will be a bit elevated in Q1. So then we're talking about potential cuts kind of after the next Fed chair, once perhaps it's Hassett. once he gets into position, then we're talking about potentially 2 more cuts. But it should be a decent year. Inflation should be decelerating, and consumers should be looking a little bit better than they've been.
Stephanie, how much of the gains in economic growth right now and then headed into next year is sort of related to AI, the spending on AI, what companies are doing around AI? How do we sort of quantify that?
Yeah, so we've looked at sort of the AI components within GDP, and our estimates suggest that it's currently on a level basis, the actual size of AI spending related to CapEx is about 1.5% of GDP. That compares to larger investment bubbles, which are 3.5 to 4.5% of GDP. So we're certainly not in bubble territory in terms of the level of investment. As for how much it's been contributing to the economy, our sense is it's boosted. It's kind of representing about a quarter of the GDP growth that we're seeing. So certainly important, not necessarily game-changing. You hear estimates out there that suggest it's about half of GDP growth. We don't think that's the case, certainly smaller than that, but also a fairly substantial portion of the growth that we've been seeing.
So even if it's not, huge, but it's still substantial, we talk a lot about how dependent the stock market is on the AI trade. We've talked less about how dependent the economy is on the AI trade. And so I wonder if you share any of the concerns out there about overinvestment and whether the AI part of the economy is a risk at the margin if it slows down.
Yeah, at the margin, it is a risk. Certainly if it slows down, because it has been an important driver of growth, if not the primary driver. However, it doesn't appear to be sort of in bubble or frothy territory. Of course, now we're starting to get to the phase where we're shifting more towards debt-financed growth as opposed to it being mostly coming from cash flow. So, of course, that becomes incrementally more risky. But as of now, it doesn't appear to be something that we should be overly concerned about. The CapEx is likely to be fairly strong for 2026. Companies need to kind of race to the investment cycle. They don't want to be left behind. We don't really know the real benefits of AI from an economic perspective. That will take a lot longer to play out. So up until then, companies are going to just continue to invest until perhaps we realize they've invested too much, and then it might be at risk of bubble territory, but we are a ways away from that.
And Stephanie, let's talk a little bit more about the Federal Reserve and especially the outlook for leadership at the Federal Reserve. If it indeed is Kevin Hassett, or really even if it's anyone who this administration is going to nominate, presumably it'll be somebody who is more dovish here. Do you think is that sort of the base case here, and what does that mean for Fed policy?
Yeah, I mean, remember that it is a vote by committee, so our expectation is even if the chair is a little bit more dovish in nature, they will have to get everybody on board. And, that might be a little bit more difficult to do, especially in an environment where inflation is still remaining elevated and rates are closer to what FOMC members view as neutral. So now it's a little bit of an easy argument come for the December meeting because many Fed members believe that we're still in restrictive territory. But once you get closer to, call it, 3.25%, 3.75%, a lot of, the decision is a lot more difficult with each additional cut. So it will be more difficult for them to sort of jam more dovish policy through. So our expectation is they'll probably get another 2 cuts or so, and then that will probably be it.
Do you think that there are still concerns around credibility at the Fed, especially if it ends up being Hassett?
Maybe at the margin. I think, certainly those fears have died down to some extent, which is, of course, really positive. We were really concerned when Fed independence was being questioned. I think what we've seen since the Cook case came out is the Fed members have kind of come together. So specifically Bowman and Waller, they all kind of voted with the rest of the committee rather than dissenting, which would have been a signal that perhaps the Fed is fraying at the margin. But now it seems that the other members have been coming together. So I think it is a concern that's lingering, but it's certainly not as severe as what was earlier the case. So it seems that the risk of, say, in February when they have to renominate the regional Fed presidents, that the members will largely get on board rather than some sort of negative event where they have trouble getting through the regional Fed presidents.
Right. And Stephanie, I do want to ask you about the labor market, the job growth backdrop here. I'm encouraged to see your estimates that you're still looking for growth in jobs next year, not declines. And what do you think is going to sort of support that job growth?
Yeah, so our view is that you'll see a bit of a pickup, and specifically in the cyclical areas of the economy. So retail, finance, leisure, manufacturing could get a little bit better. So the areas that have gotten hurt this year, largely because of economic uncertainty and the slowdown that we've seen this year, if we just see a bottoming in growth and activity picking up a bit, our assumptions are that you'll see a pickup in a lot of those areas of hiring as well. So we're looking for job growth to average around 80,000 for 2026. That compares to the recent average that's closer to 70,000, if not 60,000 if you shorten the window. So our assumptions are that you'll see just a bit of a better hiring backdrop kind of across the board. This year you've gotten a big slowdown, partially because of immigration, partially because of AI, and then the big reason and the most important reason has just been the broad economic slowdown. And those headwinds will turn to marginal tailwinds next year.
Well, the Federal Reserve's Beige Book coming out a short time ago, providing some new insight into the health of the economy. Fed correspondent Jennifer Schonberger has more. Jen.
Hey there, Josh. The Fed's Beige Book showed cooler consumer spending and hiring, along with higher prices for the first couple months in November. Consumer spending declined further during the month, due in part to the government shutdown. And this is coming on the same week that we saw retail sales for the month of September released, which were also cooler. So perhaps the consumer who had pulled back at the beginning of September continuing to spend at a tepid pace here through November. Now, when it comes to the job market, we saw a slight deterioration. Layoff announcements increased while employers are trying to limit headcount through hiring freezes, as well as only replacing people who leave. They are also managing employees through managing their hours. That is to say, if the workload increases, they increase hours using their existing employees. If the workload decreases, they decrease existing hours for existing employees. Now, also, we're seeing AI nip at the job market on the margins. A few firms reported that AI replaced entry-level positions or increased productivity for their current workforce, therefore curbing hiring. Employers are also dealing with higher labor costs because healthcare insurance premiums have gone up. Now, when it comes to inflation, the Beige Book reported a, quote, moderate increase in prices. Both retailers and manufacturers are experiencing higher costs due to tariffs. That apparently is widespread across the country. Now, the extent of passing on those higher costs to consumers has varied based on demand, competition, and of course, price sensitivity on the part of the consumer. Now, interestingly, prices declined for certain materials because of either weaker demand, reduced tariffs, or tariffs that have been postponed and haven't kicked in just yet. Looking ahead, businesses do expect that cost increases from tariffs will continue, though plans of whether to pass on those cost increases to consumers remain mixed. Of course, the Federal Reserve going to be using this anecdotal evidence for their policy meeting in just 2 weeks, and it takes on more significance because they're still dealing with a dearth of very current official data from the government to make their decision. They're actually not going to get the more current data until after their meeting. So perhaps this report taking on some more significance. And I would just say, Josh, looking at this report, the fact that consumer spending cooled, the job market looks cooler, while we saw some prices for materials coming down on weaker demand and a mixed bag of whether we could actually see price cost increases passed on to consumers, may sway them towards more of a rate cut.
All right.
Back to you.
Great roundup. Thank you, Jen. Appreciate it.